Okay, it's what is it? It is the 27th of June, 27th of June. I think we have 5 more weeks to go or 4 more weeks to go in accounting 122. Let me make this bigger. That's me. Um, I a little bit of housekeeping. The recordings are up. I'm going to record this and hopefully do homework 5 and homework 6, maybe, so that tonight I can put up chapter 8 and maybe start in on chapter 9, depending on your input on where you want to be. However, reach out to me if you need help. And I'm sorry I didn't get to this sooner. I was really tied up this week, and I sit on a board. I sit on more than one board, but on this one we're looking for a CEO. So as you might remember from your business BUS 115, I think it is, corporate structures and things like that. We're doing some of that in this class. The board of directors chooses the CEO. And so that's an important process. We had a headhunter for this. We call it a headhunter. It's a executive search company that found us found us a number of candidates, and we had to interview them as a group, as a board. So interesting. It was very interesting. If you've never interviewed anybody, maybe I'll tell some stories in class. But as you can see, the market is down 30 today. And it's very close to being even. But I'll go over some news tonight, maybe if I feel like we have some time. But obviously, in a summer course like this, it's difficult to do that kind of stuff. Even on Zoom, I'm waiting for a friend of mine or a partner of mine to come in. We're talking about doing some trading together, research together, and we'll both put up some time and money and see if we can't make some money in this market. So I'm looking forward to talking with him later, and he may show up, and you may see him. Okay, I'm going to leave the door open so that he can see me in here from the driveway. Okay, so I'm going to start right in on oh, I want to move this. Oh no, I don't want to move that. I want to move this. Make it a little smaller and put it in the corner here. Hopefully it's out of the way. I do have a whiteboard set up that I opened today that hopefully I can use. Oh, that's not it. Darn it, Cleaver. Microsoft. There's Word. Scanner settings. No, don't care about those. And what do I do with it? Is that it? Office. Oh well, I'll figure it out if I feel the need to use it. Okay. Off we go. I am recording. I just have to make sure because I'm crazy. And let's go to chapter 5 in our book, in our homework, I should say. Let me go home here. I'm going to get out of that. And I'm going to go directly to chapter 5. And now the question was on a specific question I had from a student. And again, I apologize for not getting to it sooner. I believe it was Rosemary. Could you go over chapter 5? Really stuck on one of the entries in problem 2. Okay, very good. That's where we'll go. But first, we're going to go, we're just going to go through them one by one. So here is chapter 5. And I want to make sure I'm getting it in the, getting me out of the way. Okay, so in here, we're doing inventory. And I think I said to you when I did the lecture, you know, use this handy dandy sort of, what do I want to call this? This method of presenting your data to yourself so you don't get confused. But of course, in the homework, it's given to you this way. And then you can make, it wants, well, in the first thing, it wants cost of goods available for sale. So how do we get there? Well, we had 230 in beginning inventory in my case, in my numbers. And then we had purchases on the 5th, the 18th, the 25th to give us a total of 950 at $57,230. Easy breezy. I hope so. Sort of a fill in the blanks question. No further explanations needed. On number 2. And here is where it becomes important. Compute the cost assigned to ending inventory using these different systems: FIFO, LIFO, weighted average, specific identification. For specific ID, units sold are given up here. So make sure you read the problem because you know, you'd be pulling your hair out if you don't. So let me see. Are we working with perpetual, right? So that's the important thing. I have to know that we're using a perpetual system. That means it adjusts after each transaction. So if it was periodic, it would be a little different. So I'm gonna put, I got everything here. Perpetual FIFO, right? First in, first out. And if you need to go back to that graphic, you know, that I showed you in the slides, that shows how FIFO, LIFO, and specific or weighted average work in a graphic, a little graphic presentation, which is very cool. So 290 at 58. We had 230 at 53.60, and then we have 290 at 58.60. There's no average there, so it's just their balance. When we get to our purchases on the 9th, this is COGS here, right? Where's our purchases? Yeah, cost of goods. So 230 at 53.60. They come out first, and then 160 of them. 490 was the total, right? So from our information, purchases, sales, 390 units at 88 per unit. We don't care about the retail price. All we're trying to figure out is COGS. So we go back down here and 390. So that's 230 plus 160 is 390, and that makes up our sale, and we do that times 5630, and when you, I think it does the math for you in this particular drop down. So that's what perpetual looks like. Perpetual FIFO, first in, first out. So the 230 were first in, they were from last year, so they're the first out. The 160 comes next. The $58.60 inventory comes out after this inventory comes out. So LIFO, it's just the opposite. You can see here the 100. This is 390. It's the same thing. In this case, we have 290 at 58.60. So 290 are going to come out first. No, 100 at 53.60 and 290. Yeah, so they're last in, first out. So 290 at 58.60, all of them come out, right? And that's what we do. So hopefully this makes sense. I hope it does. And we go to weighted average, and the deal there is that something we average this unit cost each time, right? So 5860 is our is what we have. So we add those up. So we have 520 at 5639. And if you're unclear on that, check your book and check my slides, and you'll see how that that math. You add 230 at 53 is 12,000. 290 at 5860 is 16,000. So you add those two numbers together, and you get 29,322. You divide that by 520, and you end up with 5639. Simple. Now, specific ID, we got the information from above, but it's also given here. So it's very simple, and works in companies like our bike shop that has all custom bicycles or something in that like that. So we have these goods purchased, and then they come out in a specific identification. So 130 units from beginning inventory, right? 110 from March 18th purchase. Okay. 110, where's the 260? 110 from March 18th. Okay, that looks good. 150 from March 25th, right? So that's specific ID. Good, that's number 2. And we're on to number 3. Here's 3. All it wants is the number of units in ending inventory, right? That would be 820 minus 580, right? Here's our 820 minus 580. 820 minus 580 gives us 240. So the units available, right, less units sold is 580, gives us that ending inventory of 240. Good. That one's a easy one. Now here again we have some data in number 4, and then we have gross profit. Compute gross profit earned by the company for each of the 4 costing methods. How do we get to that? Here's all our data again. I can bring it down with me. But actually, I don't need it. I think it'll show up here. Explanation on number 4. Sales, 505 units at 110 plus 330 units at 120 is 95,150. So there's our sales. And then we just have to come up with COGS on each, with using each system. All right, and I can go over this in class some if you don't really understand it. But less cost of goods sold. And how do you get cost of goods sold for first in, first out? Well, you have to go through each sale and make sure. So 505 units and 330 units came out. How did they come out, right? How did they come out? Well, in, first out, they came out 100 to 505. 185 units came out at 75. And what do we have? 505 minus 185 would give us 505. I have a calculator here. 505 minus 185. It's 320. 320 came out at 80. So you had 185 at 75 and 320 at 80. And then you go down to your 330 units, after you figure out what you have left. And then you take them out according to the last one in. Okay. and you continue with, or first one in FIFO, same thing, only backwards, right? And specific ID, they have some info here, right? For specific ID, all the info you need is right there. Clear as mud, I hope. I hope the sales thing made sense to you. That looks good. If we have any more questions on these, I can root them out in class. 5, same question pretty much, except it's going to have you do all of it. Compute the cost assigned to ending inventory using FIFO, LIFO, weighted average. Round your average cost to a couple of decimal places. So this is pretty cool. I think I can take this info down with me and show it to you maybe. So here we are. Just so you see it. I don't know. Dumb idea. So there it is with FIFO. There it is with LIFO. And then we come down here and we do average cost and specific ID. Okay. So that should go fairly well. I know sometimes it's confusing and a pain in the neck, but usually it works pretty good. I'm hearing things outside. Okay, that's number 5. And again, you can stop the tape and look at these numbers. 6. Now we have cost of goods available for sale and the number of units available for sale. 1780 is right here. And what is the cost of those goods? That just involves multiplication. Okay. And maybe they'll have that. And then compute the number of units in ending inventory. 1780 minus 1420. Okay, and then it goes through this, compute your costs assigned to ending inventory using these different systems. Let me get that just right. FIFO, here it is, and those balances get calculated for you, which is good. It's not brutal, right? Perpetual LIFO. Once again, it's all perpetual. And here is weighted average. And it's shorter, but you have to do that mathematical for each purchase. You're averaging your cost per unit. And then finally, specific ID. There it is. And then this one asks you to compute gross profit and bonus. Which you ask a question, a sort of a strategic management question. Company's manager earns a bonus based on percent of gross profit. Which method would he want? He would want FIFO because it's got the highest gross profit. Okay, here's the explanations. Okay, there's the first one. Goods available for sale and their value, and then the second part asks you ending inventory, 1780 minus 420, and then the number 3, FIFO, right? And it even gave you an alternate format if you're losing your mind with that first format, or you're able to do it quicker one way or the other. I don't have a preference. Some of you can do this stuff in your head pretty well. Um, I'm not one of them. I'm not. I got to write it out these days. I'm getting old. Um, I don't have that quickness I used to have. Uh, so weighted average here, right? And you can see them averaging. And then finally, specific ID. Okay. And here is sales, 1420 times $75. In number 4, right? Remember, number 4 was 1065. And then you had to put COGS in all of them. And you stole your COGS from up here. No, not there. Cost of goods sold, yeah, 69,180 is that one, right? Weighted average, it's different. Each method, it's different. 69,132, there it is, 69,132. So you get the picture. You're just plugging in numbers from at that point. Montour's manager would prefer FIFO, of course. Okay, so that was kind of a very involved question, but hopefully you got through it or are getting through it at this point. Here's number 7. Same question, sort of. I think I left some things out of it, but here you go. There's your data. Cost of goods available for sale, number of units available for sale, 10.4, right? Ending inventory, this minus this, 2370 minus 1970 is 400. Turns out, nice even number in my book. Number 3, ending inventory, FIFO, LIFO, weighted average, specific. It wants the dollar amount for ending inventory. And then compute gross profit, and then the company's manager, of course, still FIFO. Here we go with these. And then number 3 was really the tough one, because you had to figure out the ending inventory for each one of them. 445, 446, like that. So it demanded that you do this calculation. Again, some of you are probably a little quicker than I am and can do it in your head almost. So 1970 times $75, 147. Okay, that's your sales. FIFO, manager always prefer FIFO. If prices are rising, I shouldn't say that. And prices are always rising because the government is inflating the currency. That's why you have price inflation, always, since the Federal Reserve, 1913. Navajo Company, year-end financial statements for the following. Company recently discovered that making physical counts, it had a few errors. Okay. Understated. Year 1 ending inventory is understated by 50 grand. Year 2, it's overstated by 20. Is that a big deal? Well, yeah. It'll work out in the wash. You would always disclose it if you have, bank covenants, or you're a public company. You would disclose that. Prepare a table to show the adjustments necessary to correct the reported amounts. What is the total error combined net income of the 3-year period? Okay, so here's requirement 1. Key For each key financial statement figure A, B, C, and D above, prepare a table to show the adjustments necessary. All right. This just gets you to understand exactly what's involved in these errors. What is the total area net income for the 3-year period? It's kind of a trick question because it's 0. Total net income 793 is not affected by the errors. This is because these errors are self-correcting. Overstatements and understatements always work out in the wash. So it's only fraud if there's some kind of motivation behind it, some sort of making of a, you're trying to make a number so that you can get a bonus or something like that. Then it becomes it becomes seriously questionable in a fraud sense. Okay, number 9. Here's Navajo again. Making physical count. It made following errors. 56,000. I'm going to do it all over again. And here's the solution. Right? Adjustment, year 1231, year 1 error. And then in requirement 2, it again wants you to understand that is $0. Year 3, it straightens out. Okay, there's the explanation. Let's take a look at that one more time, just in case. Just in cases. Okay, requirement 2, there, we're done there. Let's go to number 10. Number 10, I just want a quick look at the market. Just because I don't trust it and I have a position on. No, we're doing fine. Okay. Never mind. Where am I? Here. Here's number 10. 4,000. If you began the year with 700 units of inventory and made these purchases, prepare a comparative year-end income statement for 3 inventory costing methods. FIFO, LIFO, and weighted average, which includes a detailed cost of goods sold section as part of your statement. Right, so detailed. And it gives you this format when you go into McGraw and open it up. But I want you to remember this. So down here, there's the explanation. Right, beginning inventory 700 times 18, and then we bought 800 at 20 and 500 at 21, and here's how it works out: LIFO, FIFO, weighted average. So again, I hope I'm not losing everybody on these things, but please feel free to ask me questions when we get to class tonight. And I'm going to go on to chapter 6 and get it in. Chapter 6 homework is right here. I think I can do it in 30 minutes or so, I hope. Notice that 2 students have submitted already. A bunch of people not started. We should get on it. 1 of 8. Keona Company set up a petty cash fund. Remember this? We're talking about petty cash and bank reconciliation. Bank to book. Bank to book. So $450 here to establish. There it is, May 1st. Prepared a company check to replenish. Here's how that looks. Here's all the little expenses. right? We debit those and credit the cash over and short and the cash. May 15th, right? Right. I hope this is not too hard. There was a increase in the fund balance. That was number 5 at the end of the day. Company decides that the May 16th increase was too large. It reduces it by $50 at the end of the day. Yes, I hope that's pretty clear. And we'll go to number 2. Same idea. We're going to do it again. Here they all are. The entries. There's the info that I have. Yours be a little different. All right, and that one again. I hope these journal entries are becoming more and more familiar and easy to do. Just keep on doing them over and over. Nakashima Gallery, the following petty cash transaction, right? The first prepared journal entry to establish the petty cash fund. We debit petty cash, credit cash, reduce our cash with a credit, increase our the other asset petty cash with a debit. And then we got this little critter here. Prepare a payments report, right? Mileage expense, reimbursement for mileage, postage expense, express delivery of contract purchase, postage stamps, $6.55. Merchandise inventory. All right, shipping charges. So this line is telling you where it would go in the general ledger, and these are just showing you what happened. So it's a real thorough. That's a really thorough report, and it works really well. And finally, journal entries to both A, reimburse, and B, increase the fund amount. Okay, by $70. So we're reimbursing with $325.42, and then we're going to add another 70 to our old account, right? It's $350 before, so $350 and 70 is what? $420. Why 420? I don't know. Maybe that's what they averaged it out over years, and it sometimes it goes up to over 400. Inflation is running pretty hot, so they had to change it. Here's number 4. Same idea, petty cash. I think I get the whole thing in there. And Nakashima, same thing. Right. All our info. 5. It's actually 5 and 6. And we move on to bank reconciliation. Remember, we have a book. Our books and our bank are different. They're different for any number of reasons, but they're pretty finite. There's only in our teaching here, there's only a couple of things that can go wrong. Somebody's walking around with a check in their pocket or things like that. So here's your info, and then we go on to the reconciliation. And notice this little format is kind of cool because it's got a bank statement and a book balance, and that way you want to make sure that these two equal each other. Excuse me. At the end, and it does. We had 3 checks over here to deduct. right? Over here, we had insufficient funds, service charge, and an error. Up here, we had a deposit that was in transit. And over here, we had proceeds from a note. So 33,348, everything lines up. We're good shape. So everything is in there, A through G, to help you out. You can even do this and sort of look it over while you're doing it. That's 6 or 5. I'm sorry, 5. Here's 6. They want you to do the journal entries. All right. Number 1, no journal entry required. Number 2, no journal entry required. But 3, we had rent expense and cash. 4, we had cash and notes receivable. 5, there's AR, eShaw, and cash. And then 6, miscellaneous expenses. 7, no journal entry required. So all you had was these 4 different entries to do on that reconciliation, right? But you got to make sure that the books in the bank agree. Here's number 7, right? And here's the information that we get, and here's how we lay it out. Bank statement balance and book balance are on. They're not off by that much, but we end up at 34,000 from 27, and they match. Excuse me. Finally, number 8. Chavez most recently reconciled bank statement of book balance and reported 2 checks outstanding. The following information is available. Here it is. This is probably the kind of format that you're going to get. Accounting records, cash payments, all that. So there's a lot of info up there. And then here's the question. Right? What journal entries do we need to do to adjust the book balance of cash to the reconciled balance? So that's chapter 6 for you. I've got about, what's on this? 37 minutes. I wonder if I should put 7 on here just for happiness sake. I think I have time. Number 7, homework. Here they are. 10 questions. I'll get through a few anyways. I think maybe all of them. So what's chapter 7 about? Merchandising. Prepare journal entries to record the transactions and events. Cash, credit cards, right? On credit. So we're journalizing each one of those things. Sold $1,000. So we credit sales and we debit AR. Mr. Morris or Ms. Morris. Natara, I assume that's Ms., but I could be wrong. Net 15, June 4th. Also, we had to do the COGS on that side because 1,000 and it cost 600. So 600 here. All right. And then you just go on down the line. Cash, credit card, and expense. It's going to be credit card expense 220. Cost of goods sold. Now let's see. There's a little explanation here. Yeah. Here's the credit card sales less fee. 11,000 times 0.02 gives you that 220. Okay, because it was 2%. 0.02. All right. Now we've got Hawk Company following results for the calendar year. Bad debts are estimated at 4% of credit sales. What's show how accounts receivable and allowance for doubtful account appear on December 31st. AR is 900, right? And less allowance for doubtful account is 3280 or what do we got? 4% of credit sales. So 40,000 minus 7,200 gives us 32.8. So here's the explanation for that and for this. So not too bad. I hope that made pretty good sense to y'all. Here's 3 and 4. I want to make some entries here. Bad debts are estimated 1.5 credit sales. Is A. B is bad debts are estimated at 1% of total sales, right? So different methodologies. Aging analysis estimates that 5% of year-end accounts receivable are uncollectible. So all of that goes into allowance for doubtful accounts. And here's the explanation. Oh, excuse me. A, B, C, 5% of accounts receivable. And there's the show. Expense at 1.5 of credit sales. So it's, 1.5%. So you're moving that decimal point 2 places. 0.015 times 5,682,000 gives you this 85,230, right? Here's number 4. Aging analysis estimates 5% of year-end accounts receivable are uncollectible. We're using the information up there. 1.2 or 1,270,100 is our AR, right? Here it is. Right, and then our allowance for doubtful accounts, we know from up there is 63,505 to give us 1,206. Right, and here's the explanation for that allowance for doubtful accounts in case you didn't grab that right away. Times 0.05 gives you 63. Good. Here's another one. Oh, God, I hope I'm woken up by the time I get to you tonight. Jardine Company's allowance for doubtful accounts and an unadjusted credit balance of 15.5. They've got a schedule of accounts received by age, right? June 30th of next year, Jardine concludes that a customer's 5550 is uncollectible. The account is written off. Does the write-off directly affect Jardine's net income? No, because we've got all this money here. If we figured out all this, here it is. The entry to write off an account includes a debit for an allowance for doubtful accounts and credit to AR, both of which are balance sheet. Net income is affected only by annual recognition of the estimated bad debts expense. Right? It's just getting you to understand the timing of these things too. Another one, prepare the adjusting entry. It's 27,150. And here's why. The difference between the estimated and the unestimated. Oops. That was a dumb move. That was chapter 7, yes. 6, 7. And I believe we were on number trace. Yeah, 1. No. Okay, did I get that far? Let's make sure. Oh yeah, 3 and 4 we did. Yep, and then we did 5. So no, those are balance sheet items. And 6. December 31st, Jordan allowance for doubtful account as an unadjusted credit balance of 14.5. So they have this age of accounts receivable, this accounts receivable graphic here, this presentation of our accounts receivable by age. So what are we going to do with that? Well, we added it all up and we ended up with bad debt expense of $27,150 and allowance for doubtful accounts of $27,150. So here's the explanation: the unadjusted balance and the estimated balance and the required adjustment. Just like in any other adjustment, you're doing the same darn thing, that 3-step move, right? Number 7. 7 is here. Liang, or however they want you to say that. The company completed a number of transactions. Sold $1,000,003. Wrote off $21,300. Received $669. Right, here's all these things. And then there's year 2. So we have a year 1, year 2 situation. Complete by entering your answers in the tab below. So here's year 1. Cost of goods sold, merchandise inventory, allowance for doubtful accounts. Sort of fill in the blanks here. There's year 2. And here's the explanations. Year 1, right? See, beginning receivables of 0, and you had credit sales and collections and write-offs and ending receivables and all that. $10,000 credit, unadjusted balance $21,000, adjusted allowance $31,000 to the nearest dollar. And then in year 2, of course, we started out with beginning balance and receivables and got to our $30,776 number. Bad debts expense, right? Okay. Year 1, year 2. What fun, right? Number 8. Number 8. Again, we've got 2 years involved, year 1 and year 2. Hopefully this is getting pretty clear for you. There's year 1. There's year 2. Right? Summarize transactions, adjustments. Here's the explanation for you. And we're off to number 9. All right, and now we have a note. And this is kind of a long question, but it's necessary. I wanted to get you to understand how these notes work. You can do them on Excel or however you want. Accepted a 13,460 days, 70% note. Always use 360 in a year for banking. So here's 1A. how do you calculate the interest amount? Well, you have the principal, the rate, the time to get you the total interest, right? And then the interest recognized through December 31st is over here, 7% times 15 days. Okay. Now I have this entry for the year one transaction, right? That $39 is from here. Okay. And then C, complete the table below to calculate the interest amounts. Midnight, Privet, Mulan, Carson. Here's some explanation, 1A through D. There they are. Whew, there's all that journalizing for the year two transactions. Hopefully that. And finally, pledges receivables. It should be in the financial statement footnotes. You always leave that note. Here's number 2. All right. 1. Requirement 2. Here's the explanation for it. Sorry. Okay. And here's an explanation of all those interest revenues. All right. That should work. I think I did the same thing again. Yes. Same question. Requirement 1. Right? And there's that $36. 1B, there we are, 10.8. $36. 1C, there's all those different notes. 1D, here's our journaling in the general journal. Go down there, and then I'll go back up here so you can see it. And follow along at home. Right? So there's that explanation in year 2. And lastly, footnotes again, right? Of course. So that should do it for those 3 chapters. At least you'll be able to check figures and see where maybe you went wrong. So I'm going to wrap it up because I'm running out of time as it is. We've got about an hour on this recording. I'll download it right away. So thanks for listening, and we will see you tonight